Taiwan is an island smaller than the state of Kerala, and yet this week something historic happened. Taiwan displaced India to become the world's fifth largest stock market. Taiwan's total market capitalization is now around $4.95 trillion, moving past India at about $4.92 trillion. How did an island of just 23 million people, smaller than Delhi, overtake a country of 1.4 billion in stock market value? The answer is largely in one company, TSMC, Taiwan's semiconductor manufacturing company. TSMC now accounts for a little over 40% of Taiwan's main stock index, and its shares are up about 50% this year on the back of AI demand. And it's not just Taiwan. In the US, memory chip maker Micron briefly crossed the $1 trillion mark in market value, putting it into the club of roughly the top 10-12 most valuable American companies, purely on the strength of AI-driven chip demand. This is not just about stock markets. This is the story of the AI race. It is the story of how economies are positioning themselves for the next decade. Taiwan is winning because they build the hardware of intelligence. And India's IT stocks have dropped sharply over the last 2 years, with the Nifty IT index down roughly around 30% from its peak, as investors reprice the impact of AI. If you are an investor in Indian IT stocks, all of this is not just headline drama. It is already showing up in your portfolio. In this video, I'm going to give you one simple dashboard for all your IT investments. Why is global money chasing Taiwan? How AI is quietly eating into Indian IT business models, and that one key indicator to track over the next 4 to 6 quarters that will tell you whether to stay put, cut back, or add more to your IT investments. To understand why Taiwan is surging while Indian IT bleeds, let me introduce you to a framework, concrete versus cognition. Economists Rohit Lamba and Raghuram Rajan have been arguing that India's state and corporate sector deeply understand concrete, that's land, power, construction, operations, but do not understand cognition, the intelligence layer. Let's understand this with an example. Take Google's Vizag AI Hub that was announced in late 2025 as a showcase AI and cloud infrastructure investment. Here's what actually happens in that stack. The chips are designed in the US, fabricated in Taiwan by companies like TSMC. The AI models are trained and owned in places like Mountain View, and India provides the land, power, constructions, and daily operations. So every time an AI system sitting in a Vizag server answers a question, a tiny fee leaves India and goes to the foreign company that owns that model. The building is Indian, the land is Indian, but the chip was made in Taiwan, and the AI model is trained and owned in places like Mountain View in the heart of Silicon Valley, California. This is not a new story for India. This is the story of the last 30 years. In the 1990s, India did not have the capital or technology base to build semiconductor fabs the way Taiwan did. So we became brilliant at deploying systems that the other people designed, and we postponed the work of designing them. We built a multi-trillion rupee IT services industry. TCS, Infosys, Wipro became global names. It was a triumph. We created millions of jobs and turned India into the back office of the world. But here's the uncomfortable truth. We learned magnificently to deploy. We never learned to design at scale. And now in the AI age, we are repeating the exact same pattern. Except this time, the stakes are higher. Because this isn't just about business, this is about sovereignty. Let me give you the numbers for the Economic Survey 25-26. Only about 2% of world's AI training data startups are based in India. In the United States, that number is 40%. In the European Union, that is just over 20%. India is just 2%. We are a nation of 1.4 billion people. We have one of the world's largest IT services industry. We produce millions of STEM graduates and software engineers, and we account for 2% of world's AI training data startups. Now compare that to other much smaller economies. Korea is smaller than Karnataka. Taiwan is smaller than Madhya Pradesh. And yet Korea built Samsung, Taiwan built TSMC. They designed the tech and owned it. India built outsourcing, and now as the world moves from outsourcing to intelligence, we are being left behind. Here is the deeper problem, and this is where Vinod Shankar at Java Capital adds a crucial investor lens. India spends only 0.65% of GDP on research and development. China, on the contrary, spends 2.65%. The United States 3.45% and Israel more than 6% of its GDP. In countries like the US, China, Israel, Japan, South Korea, the private sector funds the overwhelming majority of R&D. In India, private companies account for barely a third of the R&D spending. The rest is almost entirely by government labs and public agencies. Take for instance the big Nifty 50 banks. R&D doesn't even show up as a meaningful budget line despite their massive budgets. As Shankar points out, India's mutual fund industry is a massive success. The campaign Mutual Fund Sahi Hai has worked out really well. But what the SIP boom has created is a nation of people funding yesterday's winners. We are efficiently allocating capital to companies that are serving the existing economy. What we are not doing is funding the companies that will build the next one. Mutual Fund Sahi Hai is true, but startup bhi karna hai, that part of the campaign was never made. In February 26, AI fears wiped $50 billion of Indian IT stocks in a single week. TCS is down double digits this year. Wipro has been hovering around its 52-week lows. The Nifty IT index has dropped around 28% from its peak. Meanwhile, foreign institutional investors, FIIs, have pulled over 2 lakh crore out of the Indian secondary market in 26 alone. Where is that money going? Among other places, it is going to Taiwan, South Korea. Global investors are looking for the AI trade and they can't find it in India. Why is the Indian IT crashing? First, big companies needed TCS, Infosys, Wipro for most large tech projects. Now, many of them use AI tools inside their own teams. Managers use AI co-pilots, developers use AI coding tools. They can run pilots and save costs without calling an outside vendor. Second, users report roughly 40% less human coding for the same work when they use AI coding tools. A project that needed 100 engineers can now be done with only 60. A $10 million build can now come closer to $6 million with similar quality. That means global firms need fewer engineers overall and keep more work in-house instead of outsourcing it to India. Third, you can already see this pattern in Indian banks. Some large lenders are growing their business, even opening new branches, but their total staff count is flat or slightly down, and they link this directly to tech-driven productivity gains. More business with fewer people is great for margins, but it also hints that the full impact on IT services, jobs and revenue is still not fully captured in most forecasts. So what are TCS, Infosys and Wipro doing about this? They are trying to keep their old people-heavy revenue streams intact, even as they sell new AI-heavy projects that by design need fewer people. TCS now reports more than $2.3 billion of annualized AI revenue out of $30 billion of their total revenue. So AI is still only mid to single digits of the business, even though it is growing much faster than the company. Infosys tells a similar story. Management and analysts say AI-led deals are growing quickly and driving much of the excitement, but overall revenue is still growing only in the low single-digit quarter on quarter. The honest truth is, Indian IT companies are in stage 1 of the disruption. They're trying to protect the old business while building the new one, which is a losing game. And the paradox that is also destroying Indian IT stock valuations is the efficiency paradox. AI is making these companies more efficient. They're doing more with fewer people. Revenue per employee goes up. Margins can expand on paper. And that should sound good for the stock, right? But the market is also pricing in the headcount loss and the macro shock. If a company can grow revenues with fewer engineers, then over time it will need fewer engineers. And in India, IT service employment is not just a line item. It's a core pillar of urban middle class consumption and tax receipts. So investors are asking, if TCS or Infosys are growing revenue but shrinking net headcount, what happens to the broader Indian economy? What happens to wage growth, consumption and credit demand? That is why you can see a situation where earnings look okay, margins look okay, but stocks are still down sharply because the market is trying to price in a structural shift not just a one-off bad quarter. Some argue that there is a bull case for India. You don't have to invent jet engines to run a great airline. Power can also flow from being an agile adopter, an efficient diffuser, a competitive enabler of adoption. India's edge is diffusion. We are very good at taking technologies and spreading them across millions of small firms, informal businesses, and underserved consumers. That is a real advantage, sure. But the problem is that diffusion is usually a low margin business. Invention, on the contrary, is where the money lies. In this AI value chain, the US will invent the base models and software, Taiwan and Korea will manufacture the chips, India will deploy the AI to its vast user base. Everyone will make money, but the US and the chip economies will likely make many more times per unit of the value than India. That is the trade-off the market is starting to price into the Indian IT and increasingly into the overall equity story of India. So if you own Indian IT stocks, what should you do? It really depends on your time horizon, on whether you believe India will seriously fund AI and deep tech R&D. In the next 12 months, AI deals and efficiency gains are real. If we get a couple of decent quarters and FII selling slow down, and the beaten IT stocks can see a bit of a tactical bounce. Over 2 to 3 years, the impact on jobs becomes harder to ignore. If a company revenues keep growing while keeping employee numbers flat or falling, that points to a macro drag on the wage growth and urban consumption. In 5 years plus, either India builds a serious AI and deep tech ecosystem backed by domestic capital, in which case today's IT majors can evolve into true innovation platforms, or they stay efficient service providers in someone else's AI stack. The one indicator that I promise to share with you is to track revenue growth versus headcount growth at the big IT firms quarter after quarter. If revenue keeps rising but headcount is flat or shrinking, it will indicate that AI-driven productivity is real and that the pressure on IT jobs and on India's consumption story is structural and not just a short-term scare. Here's the uncomfortable truth. India is winning at the game we've always played. We are the best in the world at deploying technology that other people have designed. But the game is changing and we are not playing the new game. We are still playing the old game better while the world moves on. Korea built Samsung, Taiwan built TSMC, India built outsourcing. The question is, what will India build next? Because if the answer is nothing, then Taiwan won't be the only country overtaking us. I'm Yashodhara and you're watching DeKoder. If this helped you see India's AI race and your IT stocks a little more clearly, share it with a friend who's also trying to make sense of what to do with their IT investments. And tell me in the comments what part of India's AI story you like me to decode next. See you soon.